The graveyard of capital is paved with the intentions of investors who believed that history would not repeat itself. Wall Street history is not merely a collection of dates and figures. It is a recurring cycle defined by inevitable booms followed by devastating busts. From the panic preceding the 1929 Great Crash to the systematic failures exposed during the 2008 financial crisis, the patterns of financial destruction remain strikingly constant. The central analytical finding derived from studying these market catastrophes is simple yet often ignored. Almost all major financial losses stem from the systematic disregard of basic, repeated historical rules concerning risk management and investor psychology. This analysis is dedicated to presenting 12 historically validated rules, developed not for speculative gain, but specifically for the preservation of capital. These principles are the foundational defense mechanisms necessary to survive the inevitable volatility inherent in the financial markets. The rules presented here are derived directly from the hard-won experiences of legendary survivors and financial architects who navigated the most treacherous periods in market history. We will move beyond anecdotal stories to focus analytically on the mechanisms of failure, using history as our guide to prevent the recurrence of catastrophic loss in our own portfolios. Before we delve into these crucial historical lessons, please take a moment to subscribe to the channel and leave a quick comment below. Even a single word in the comment section is immensely helpful, as this simple action signals to the algorithm that this content holds value for the broader financial community. Your engagement ensures that this type of rigorous historical analysis can reach more people who need to fortify their portfolios against future shocks. Furthermore, please make a mental note to return to this channel whenever trading becomes challenging, your confidence starts to waver, or the markets induce excessive fear. We are entering a realm where discipline is the ultimate currency, and historical knowledge is the only true advantage. The first and most critical rule established by historical analysis is the principle of capital preservation, famously articulated as Warren Buffett's Rule Number 1. Never lose money. This mandate is not a philosophical preference. It is a strict mathematical necessity for achieving long-term compounding success. If an investor focuses solely on maximizing potential return without first ensuring the safety of the principal, they are engaging in speculation, not investment. History is replete with examples of fortunes that were wiped out simply because their owners focused exclusively on the upside potential while ignoring the devastating consequences of risk. The mathematical necessity of capital preservation is brutally clear when considering recovery rates. If an investor suffers a 50% loss on their capital, they do not require a 50% gain to recover. They require a staggering 100% gain merely to break even. This disproportionate recovery requirement illustrates why the initial loss is far more damaging to long-term wealth creation than a missed opportunity for a significant gain. Legendary investor Benjamin Graham, Buffett's mentor, instilled this defense-first mentality following the brutal lessons of the Great Depression. During the 1920s boom, countless investors disregarded this principle, chasing increasingly risky assets with the assumption that the market would always recover quickly. When the crash arrived, those who had prioritized high returns over security found their capital halved or entirely eliminated, facing an insurmountable challenge of recovery. The historical record confirms that even modest, consistent gains, when compounded over decades, far outperform sporadic, high-risk ventures that inevitably face major setbacks. Capital preservation must always be the foundational filter through which every investment decision is processed. This rule demands a shift in mindset from seeking immediate profit to ensuring long-term survival in the face of inevitable market turbulence. Every decision must be viewed through the lens of potential downside risk, rather than simply focusing on the potential reward. The market will always offer opportunities to make money, but it rarely offers a second chance to recover capital that has been recklessly lost. The second rule, learned through the painful education of early market titans, is the requirement to cut all losses quickly and without hesitation. This is the Livermore lesson, derived from the experiences of Jesse Livermore, one of the most famous speculators of the early 20th century, whose life story is detailed in Reminiscences of a Stock Operator. Livermore initially suffered repeated devastating losses because he allowed small errors in judgment to become emotionally charged, catastrophic failures. He learned that hope is the most expensive emotion on Wall Street. Livermore's eventual success hinged entirely upon his rigid adoption of the fixed percentage loss limit, historically set at 10% of the position value, as an absolute non-negotiable rule. This stop-loss order acts as an automatic mechanism to neutralize emotional interference when a trade moves against the initial thesis. By implementing this rule, an investor ensures that they are never exposed to a catastrophic market shift that turns a minor mistake into a portfolio-ending event. This discipline was particularly crucial during the highly volatile commodity and stock trading environments of the early 1900s, where prices could move dramatically within hours. The historical evidence shows that investors who hesitate to liquidate a losing position are often paralyzed by the psychological phenomenon of loss aversion. They convince themselves that the stock will come back, transforming a small, acceptable loss into an unmanageable failure that consumes disproportionate amounts of capital. The stop-loss rule forces the investor to accept their initial analysis was incorrect and redeploy the remaining capital into a more promising opportunity. This proactive approach prevents the psychological burden of a major loss from clouding subsequent critical trading decisions. The mandatory stop-loss ensures that the investor lives to fight another day, guaranteeing that no single trade, regardless of how promising it initially appeared, can single-handedly destroy the entire portfolio. It is the ultimate insurance policy against the inherent unpredictability of the market. This rule demands mechanical execution. Once the predetermined threshold is breached, the position must be exited instantly, without rationalization or delay. The third rule, deeply etched into the records of the Great Depression, is the strict prohibition against adding capital to a trade that is moving against the entry price, commonly known as averaging down. This practice, while intuitively appealing to the novice investor, is one of the quickest paths to ruin when a major trend reversal occurs. The rationale behind averaging down is simple. By buying more shares at a lower price, the investor decreases their average cost per share, requiring a smaller rebound to break even. However, the historical context of the 1929 market decline reveals the inherent flaw in this strategy. As the market began its descent, small investors, desperate to recover their paper losses, continuously poured more money into declining stocks, believing they were buying bargains. This action exponentially increased their exposure to the very trend that was destroying their capital. Instead of mitigating risk, they concentrated it precisely where the market was weakest. This disastrous behavior turned manageable small losses into unmanageable catastrophic failures when the downward trend accelerated, culminating in waves of forced liquidation and margin calls in late 1929 and early 1930. The investors who averaged down were the first to face ruin because their available capital was completely tied up in rapidly devaluing assets. The market was signaling that the initial investment thesis was fundamentally wrong, yet the investor chose to double down on the error. Averaging down violates the core principles of risk management by increasing position size in the face of negative price action. If a stock is falling, it is falling for a reason, and historical analysis suggests that attempting to catch a falling knife often results in severe injury. True discipline dictates that capital should only be added to positions that are proving the initial analysis correct, or to entirely new opportunities that present superior risk-reward profiles. The fourth rule establishes the necessity of strict position sizing, mandating that an investor never risk more than a defined, small percentage of total trading capital on any single position. Historically, this risk level is set at 1 or 2% of the total portfolio value. This rule is a direct synthesis of lessons learned from the chaotic, systemic shocks that define modern market history, particularly the 1987 Black Monday crash. The 1987 crash demonstrated that even the most rigorous fundamental analysis or technical predictions can be overridden by unforeseen systemic volatility, often triggered by computerized selling or global economic contagion. In such an environment, the only defense an investor possesses is the structural integrity of their portfolio, ensured by small, controlled position sizes. If an investor risks only 1% per trade, they could theoretically withstand 50 consecutive losses before exhausting half of their capital. This strict limitation ensures survival during periods of massive unforeseen volatility that are impossible to predict analytically. If an investor, for example, risks 10% of their capital per position, only 5 consecutive losses would wipe out half the portfolio, a scenario that is highly probable during a deep bear market or systemic crisis. The goal of the 1 or 2% rule is to ensure that no single investment error or unpredictable market event can sink the entire operation. The implementation of this rule is the bedrock of professional risk management and separates the disciplined trader from the reckless gambler. It forces the investor to manage their capital as a strategic resource that must be conserved at all costs. The historical record overwhelmingly supports the notion that those who survived and ultimately thrived after major crashes were the ones whose position sizing allowed them to absorb massive shocks without being forced out of the market entirely. The fifth rule, the cornerstone of value investing and capital preservation, is the requirement to demand a substantial margin of safety in every purchase. This principle, codified by Benjamin Graham and David Dodd following the economic devastation of the 1929 market collapse, mandates that assets only be purchased when their market price is significantly below their rigorously calculated intrinsic value. This concept is fully detailed in their seminal work, Security Analysis. The margin of safety is essentially a protective buffer designed to shield the investor from two primary risks: analytical error and unexpected economic downturns. Graham understood that no valuation model is perfect, and economic conditions can deteriorate rapidly and without warning. By purchasing $1's worth of assets for 50 or 60 cents, the investor creates a substantial cushion against both poor judgment and market volatility. This focus on deep value is inherently defensive. Historical analysis reveals that during speculative booms, the margin of safety evaporates entirely as assets are purchased based on optimistic projections of future growth rather than current verifiable value. When these projections fail to materialize or when economic headwinds hit, the investor who paid full price suffers the full extent of the correction. Conversely, investors who adhered to the margin of safety principle, like Graham himself, saw their capital preserved because the market price was already discounted to such an extent that further drops were limited. The margin of safety ensures capital preservation even if the forecast turns out to be slightly wrong, or if the company faces temporary operational challenges. It is the analytical mechanism that operationalizes Buffett's rule number 1. This disciplined approach prevents investors from succumbing to the temptation of chasing popular, highly priced stocks, forcing them instead to seek out unpopular, undervalued opportunities that offer inherent protection. The sixth rule, perhaps the most critical lesson derived from the 1920s bull market collapse, is the necessity of using leverage sparingly, if at all. The investor must possess a deep and sober understanding that margin debt accelerates losses exponentially, turning minor market corrections into financial ruin. The use of leverage or buying on margin was the primary fuel and eventual detonator of the 1929 crash. During the speculative frenzy of the late 1920s, margin requirements were incredibly low, often allowing investors to purchase stocks with only 10% cash and 90% borrowed funds. While this accelerated gains during the ascent, it created an extremely fragile financial system. When prices dropped slightly, these massive leveraged positions instantly fell below the maintenance margin levels, triggering immediate margin calls. The historical mechanics of forced liquidation were devastating. Investors who could not meet the margin call were forced to sell their holdings, regardless of price, to pay back the broker's loan. This forced selling flooded the market with supply, driving prices even lower, which in turn triggered more margin calls, creating a catastrophic feedback loop that destroyed capital rapidly and systematically. Leverage did not just amplify losses, it accelerated the systemic failure of the entire market structure. Avoiding excessive leverage is a non-negotiable rule for capital preservation. While leverage can increase returns during a bull market, its inherent risk during a downturn makes it a weapon against the investor's own survival. The disciplined investor recognizes that slow, steady growth without debt exposure is infinitely preferable to rapid, debt-fueled gains that carry the existential risk of total annihilation during a crisis. The seventh rule emphasizes the crucial psychological discipline of separating personal opinion and emotion from objective market reality. The Baruch Principle dictates that investors must ignore their hopes, fears, or emotional attachments to specific stocks, and instead follow the objective price action and volume indicators. Bernard Baruch, a powerful figure in American finance, famously survived the 1929 crash precisely because he adhered to this ruthless objectivity. Baruch observed that by mid-1929, despite the pervasive optimism and the endless chorus of new era theories suggesting stocks could only go up, the underlying technical and economic indicators were flashing warnings. He systematically liquidated his major positions, based purely on the objective signs of overheating and slowing volume, ignoring the widespread belief that the boom would continue indefinitely. His discipline in acting on the market he saw, rather than the market he wanted to believe in, saved his fortune. The historical tendency of investors is to rationalize negative price action, or to cling to a stock because they have an emotional attachment to the company or the initial investment thesis. This psychological bias prevents them from taking the necessary painful step of cutting a loss, which violates Rule 2. By demanding objectivity, the Baruch Principle serves as a vital safeguard against confirmation bias and emotional inertia. This rule compels the investor to constantly check their ego at the door and accept that the market, as expressed through price and volume, is the ultimate arbiter of value and trend. When the objective data contradicts a personal belief, the data must be followed instantly. The market does not care about the investor's feelings, and those who survive the longest are those who accept this brutal truth and adjust their strategy accordingly. The eighth rule, highlighted powerfully by the financial crises of the early 20th century, particularly the Panic of 1907, is the prioritization of liquidity in times of market stress. The rule states that during moments of panic or systemic breakdown, cash and highly liquid, easily convertible assets are the most valuable holdings an investor can possess. Paper profits in illiquid assets can vanish overnight when the market freezes. The Panic of 1907 demonstrated that when trust evaporates, liquidity becomes king. Banks and investment houses, despite holding substantial assets, failed because those assets, like certain railway bonds or complex trust holdings, could not be sold quickly enough to meet redemption demands. J.P. Morgan famously stepped in to stabilize the system by marshaling large pools of readily available cash to inject into the failing institutions, highlighting the supreme power of liquid capital during a crisis. Historical crises prove that illiquid assets can temporarily become worthless, or at least impossible to sell at any reasonable price. If an investor is forced to sell an illiquid asset during a panic, they will inevitably receive a fire sale price, often suffering a far greater loss than necessary. Conversely, the investor holding cash preserves their capital entirely and, crucially, gains the ability to deploy that cash when others are panicking and selling valuable assets at irrational lows. This rule is a strategic mandate for defense. Maintaining a significant cash position, even if it feels unproductive during a raging bull market, is the ultimate insurance policy against systemic risk. When the market inevitably corrects, that reserved liquidity transforms from a stagnant holding into ammunition, allowing the disciplined investor to purchase assets at historic discounts when everyone else is paralyzed by fear or lack of funds. The ninth rule is the definitive axiom of contrarian investing, insisting that the greatest long-term opportunities arise precisely when fear and panic have driven prices to irrational, unsustainable lows. This rule is famously encapsulated by the quote attributed to Baron Rothschild, who advised buying when there is blood in the streets. This advice is emotionally difficult to follow, yet analytically essential for maximizing capital growth after preservation has been secured. Historical analysis of market bottoms confirms this truth repeatedly. During the 1987 crash, the maximum point of systemic fear coincided almost perfectly with the maximum long-term value for a vast number of high-quality stocks. Similarly, in the wake of the 2008 financial crisis, when investor sentiment was at its nadir and the future looked bleakest, the most significant wealth-building opportunities of the subsequent decade were created. The difficulty in executing this rule is purely psychological. When fear is pervasive, the natural human instinct is to retreat and preserve whatever capital remains, often leading to selling at the absolute bottom. The disciplined, historically informed investor, however, recognizes that maximum pessimism is structurally required for maximum long-term opportunity. They see widespread fear not as a signal for flight, but as a signal that assets are now deeply discounted below their intrinsic value. To successfully apply this rule, the investor must have meticulously adhered to the preceding 8 rules of capital preservation, ensuring they possess the necessary liquidity, Rule 8, and the analytical discipline, Rule 7, to act decisively during chaos. Buying when the street is bloody is not reckless. It is the logical conclusion of demanding a high margin of safety, Rule 5, during periods of extreme market inefficiency. The 10th rule is a warning against the corrosive effect of relying on unsolicited advice, rumors, or market tips, insisting instead on the necessity of conducting independent, rigorous analysis. This principle is deeply rooted in the historical prevalence and ruinous impact of bucket shops in the early 20th century. Bucket shops were illicit operations that posed as brokerages but never actually executed trades, instead betting against their own customers. These operations thrived by encouraging reckless speculation based on false insider information and hyped rumors, profiting immensely when their clients inevitably lost their capital. While bucket shops have largely been eliminated, the modern market equivalent, unverified social media tips, anonymous online forums, and high-pressure sales pitches, carries the same destructive potential. Acting on hearsay is fundamentally an abdication of financial responsibility and due diligence. The historical lesson is that true information that leads to high probability, low-risk opportunities is almost never freely distributed to the masses. If someone is giving away a guaranteed tip, they are almost certainly profiting from the recipient's action or lack of analysis, not from the accuracy of the tip itself. Disciplined investors understand that their edge comes from superior analysis and patience, not from secret insider knowledge. This rule demands intellectual humility and rigorous skepticism. Every investment idea, regardless of its source, must be subjected to the investor's own independent valuation and risk assessment framework. Relying on tips violates the margin of safety principle, Rule 5, because it substitutes hope for analytical rigor, inevitably leading to poor entry points and heightened exposure to risk. The 11th rule requires the investor to develop the skill of recognizing institutional selling, or distribution phases, before a major market decline begins. This analytical skill is based on methodologies developed by Richard Wyckoff, who analyzed the actions of large institutional capital by reading the tape in the early 1900s. Wyckoff recognized that major market tops are not sudden events but carefully orchestrated processes. Distribution is the phase where large, informed capital quietly exits their positions, often selling into the excitement and enthusiasm generated by the late-stage retail crowd. This selling is disguised by manipulative price action. Historical chart patterns show that during a distribution phase, high volume often accompanies little upward price movement, or even slight declines. This is the critical signal. The market is absorbing massive institutional selling pressure without the price collapsing yet. The disciplined investor must learn to interpret these signals, recognizing that the market is losing its upward momentum, even while optimism remains high. Ignoring this quiet distribution phase is historically one of the most common mistakes made by investors at market peaks, as they confuse the high volume of transactions with continued buying interest. They fail to see that the transactions represent large sellers unloading shares onto eager, less informed buyers. Identifying distribution is a proactive defense mechanism, allowing the investor to liquidate positions while prices are still high, rather than waiting for the inevitable collapse. This methodology provides a crucial technical counterpoint to the fundamental analysis of the margin of safety, ensuring the investor exits the market when the supply-demand dynamics shift decisively against them. The 12th and final rule focuses entirely on controlling the destructive psychological impulse to panic. It mandates that investors must not allow short-term volatility or fear to dictate their long-term strategy or trigger panic selling. Volatility is a normal, historically constant feature of the market, not an immediate signal for flight or a reason to abandon a well-researched thesis. Peter Lynch, a legendary fund manager, frequently observed that most investors miss out on significant long-term gains, not because they chose bad stocks, but because they sold their best-performing stocks too early during minor market corrections. They allowed the temporary emotional whiplash induced by a 10 or 15% drop to override the fundamental long-term case for the investment. This behavior destroys the power of compounding. Maintaining a dispassionate analytical approach during periods of sharp decline is paramount for long-term success. If the fundamental reasons for the investment remain sound, the company is profitable, the valuation still offers a margin of safety, and the industry is stable, then short-term price drops should be viewed as noise or potentially as buying opportunities. Panic selling locks in permanent losses based on temporary fear. History teaches that the market always recovers from every systemic shock given enough time, but individual investors rarely recover if they sell at the bottom. The survival of capital often depends less on intellectual prowess and more on the sheer psychological endurance required to hold firm during the inevitable storms. This final rule is the synthesis of all preceding discipline, demanding patience and unwavering commitment to the long-term historical view. The 12 rules derived from Wall Street history are not a secret formula for getting rich quickly. They are, collectively, a rigorous and historically validated framework for survival. They represent the collective wisdom extracted from centuries of financial failure and success. The fundamental realization is that capital preservation is the absolute prerequisite for long-term compounding. Without the ability to survive multiple economic cycles, the investor will never benefit from the exponential power of sustained growth. These principles show that while the vehicles of investment change, from railroads and commodities to technology and cryptocurrencies, human psychology and the underlying mechanisms of financial loss remain strikingly constant. The greed that fueled the 1929 bubble is the same greed that drives reckless speculation today. The fear that triggered the 1987 crash is the same fear that causes panic selling in modern markets. Adherence to this historical discipline is the only true sustainable defense against losing money unnecessarily. By implementing mandatory risk controls, demanding a margin of safety, and maintaining psychological resilience, the investor transforms from a participant subject to market forces into a disciplined operator who manages risk proactively. This is the difference between lasting wealth and fleeting speculative gains. For those seeking to deepen their understanding of trading psychology and the historical lessons of discipline, we highly recommend the new edition of Reminiscences of a Stock Operator. This classic work by Edwin Lefebvre offers an unparalleled, deep analysis of the psychology and strategies employed by Jesse Livermore, whose lessons on cutting losses and market discipline are timeless. This modern edition is enhanced with unique, practical commentary and detailed breakdowns for every chapter, effectively transforming Livermore's raw historical experience into actionable, practical lessons specifically tailored for contemporary traders navigating today's complex markets. You can find the link to this essential guide in the description below.